Hello everyone, welcome to EduTap and welcome to today's session. So today we are starting with the monthly revision session. Okay, so many of the students have been requesting us to restart the monthly revision session, and from today onwards we are restarting the monthly revision session. So every Friday at 5 p.m. you will be getting the monthly revision session. So today is your monthly revision session for the RBI notifications, RBI press releases, RBI circulars, plus the finance current affairs. Okay, this is for your February 2026, and this is for your RBI Grade B 2026 examination. Okay, next Friday at 5 p.m. you will get the revision, the monthly revision session for the reports and schemes for the February 2026. Okay, so so many of the students have been requesting us, and we now have restarted the monthly revision session, and we are starting with the revision of February 2026 because if you start your preparation from now, then you will have good number of months till the examination. Okay, and in the February 2026 we will focus on the most important RBI notifications, we will focus on the most important finance current affairs, RBI press releases that are more relevant from the examination perspective. Okay, so give me a thumbs up if I'm clearly audible and the screen is visible and there is no problem that is coming in the video. So now let's get started, and today we will do the MCQs. So this is the revision session where through the MCQs we will be revising, and this will help you a lot in your practice and to see that how much you are able to recall. Okay? So let's get started, and before starting with the session, do subscribe to the YouTube channel of EduTap so that you continue getting the relevant videos, as well as do join our Telegram channel. In the Telegram channel of EduTap, you will get the PDF of the session, okay? And the link for the Telegram channel is provided in the description box below. So now let's get started. First question is in front of you. First, we are starting with the MCQs from the RBI notifications, RBI press releases, from the RBI circulars. So starting with the first question that is in front of you. RBI has issued an amendment regarding lending to micro, small and medium enterprises sector directions 2026. Its objective is to improve the ease of access to credit by enhancing the limit of collateral-free loans to the micro and small enterprises from 10 lakh to what? So this is a very easy question, but this is very important from the examination perspective because the initiative has been taken for the micro and small enterprises, which is considered a backbone of the Indian economy. Okay, so what is the answer here? Yes, C is the answer. The limit has been increased. The collateral-free loan limit has been increased from 10 lakh to 20 lakh. Okay, so this is the answer. This we have discussed again and again, that the banks are mandated not to accept collateral security in the case of loans up to 12 lakh. But if the bank want, then the banks may, on the basis of the good track record and financial position of the micro and small enterprises, they can dispense with, or they cannot take the collateral for loans up to 25 lakh. Okay, so it is mandatory to not take the collateral for loans up to 20 lakhs for the micro and small enterprises. The banks, on the individual basis, seeing the good track record, seeing the good financial position of the micro and small enterprises, can also dispense with the collateral requirement up to 25 lakh rupees. Okay, now coming to the next question, that is regarding your risk-based framework. That is a very important framework that has been brought by the DICGC. So based on a comprehensive review, DICGC has, with the approval of the Reserve Bank, decided to implement a risk-based premium framework with effect from April 1, 2026. Which of the following statements is or are correct regarding the risk-based premium? So risk-based premium framework has been introduced by the DICGC, that rather than taking the flat rate of 12 paise per 100 rupees, the DICGC has decided that the insurance premium will be taken, the deposit insurance premium will be taken from the banks on the basis of the risk that the banks have. Okay, so rather than taking the flat rate of 12 paise per 100 rupees, the DICGC has decided that for the deposit insurance premium will depend upon the risk that the bank has. Now the local area bank and which category of bank will continue to pay the card rate, that is 12 paise per 100 rupees for the accessible deposits due to the data point limitations. So it is not small finance bank, but which bank will continue to pay the card rate? So it is payments bank. Okay, so local area bank and the payments bank, they will continue to pay the card rate. Now the discount or risk model, as per the risk-based premium, the risk model says that the less riskier the bank is, the more the incentive the bank will get, or the more the discount the bank will get in paying the insurance premium. So discount or risk model incentive available to safest bank that has the least risk is 33.33% of the card rate, which represents the highest permissible reduction in premium for eligible banks. This is absolutely correct. The commercial banks other than the regional rural banks are rewarded for long-term stable operations without major stress. So with vintage incentive, so other than the discount, they also get the vintage incentive that is of 1% premium discount for each completed year. So this is also correct. So first one was wrong because instead of small finance bank, it should be payment bank. But the second and third option is correct. And that's why the right answer here is B. So right answer is B. Okay. So B is the correct answer. Here you can see that the risk-based premium framework divides the banks into two tiers. Tier 1 are the commercial banks other than regional rural banks. Tier 2 are the RRBs and the cooperative banks. So the local area banks and the payment banks, they will continue to pay the card rate. They do not have the feature of risk-based premium. Now the different banks, on the basis of their risk, the lower the risk you have, the higher the category you are in. So the lower the risk the bank has, the higher the category the bank is in, and more discount the bank will get in paying the insurance premium. Okay, so the lesser the risk, the lesser the premium you have to pay because you are in the higher category. So the highest discount that you get, that a bank gets, is 33.33% of the card rate. Now the vintage incentive is also provided to the bank. So the longer the stable operations of the bank are, the without a major stress, so the bank get the vintage incentive. The tier 1 bank, that is the commercial bank excluding the RRBs, they get 1% of the premium discount for each completed year without any restructuring, without any major stress. While for RRBs, state cooperative bank, district cooperative banks, tier 4 UCBs, they get flats 25% premium discount for 25 years of satisfactory conduct. Okay. Now coming to the next question, that is regarding your digital payment index, RBI DPI. Okay, so there is a question that is coming, that how many questions can you expect? So in 2025, there were around 7 to 8 questions from the RBI notifications, and there were around 7 questions from the finance current affairs. In the phase 2 also, there were questions from the finance current affairs. There were around 5 questions from the finance current affairs, while from the RBI notifications, there were 2 descriptive questions. So you can understand that the RBI notifications, finance current affairs, they are important from the phase 1 as well as from the phase 2 perspective. Now coming back to the question, the RBI DPI for September 2025 stands at 516.76. So you have to tell that which of the following statement is or are correct in regards to the digital payment index. So RBI has been publishing a composite digital payment index since January 1, 2021 to capture the extent of the digitization of payments across the country. This is absolutely correct. RBI has been publishing a composite RBI DPI since January 1, 2021. RBI DPI has been constructed with March 2018 as the base period. So this is wrong. 2019 is not the base period. 2018 is the base period. Okay. RBI DPI has 5 broad parameters with the payment performance having maximum weightage of 45%. So this is absolutely correct. So first and third statements are correct, and that's why the right answer here is E. Very good, Akshu. Very good, Kashish. So E is the right answer. That you can see that the RBI DPI has been published since January 1, 2021, and here there are 5 parameters on which the RBI Digital Payment Index depends upon. The highest weightage is given to payment performance, and the base year for RBI DPI is March 2018. Okay. Now coming to the next question, that RBI has been conducting Financial Literacy Week every year since 2016 to promote financial awareness among the public. The 11th edition of the Financial Literacy Week was conducted in 2026. In this context, which of the following correctly states the theme of Financial Literacy Week 2026? Remember this, that in the phase 2 usually happens that a broad paragraph is given. Let's say it is about the financial inclusion or it is about the financial literacy, and there are multiple like 3 to 4 questions regarding that paragraph. Okay, so a paragraph can come on the financial literacy, and the question can be on the Financial Literacy Week and the other initiatives that have been taken for the financial literacy. So such a question can come. Try to answer this question. The right answer here is D. Very good. KYC, your first step to safe banking. This is the theme of the Financial Literacy Week 2026. Okay, so this is the theme. Now, we have discussed this about the Financial Literacy Week 2026. The theme is KYC. your first step to safe banking. Okay, and banks were urged to use the Financial Literacy Week to spread the awareness, to highlight the role of the central KYC records registry to educate the customers and such. Now coming to the next question. As per the recently released Foreign Exchange Management, Borrowing and Lending Regulations 2026, an eligible borrower they can raise external commercial borrowing. So a borrower in India can take the external commercial borrowing, that means can borrow from outside, from the other countries, up to what limit? Up to what limit? Outstanding external commercial borrowing up to what? Or total outstanding borrowing up to 300% of the net worth. So basically, an eligible borrower of India can borrow external commercial borrowing or can take the borrowing from outside up to the higher of the external commercial borrowing up to $1 billion or up to 300% of the net worth, whichever is higher. Okay, if the $1 billion is higher, this much of the external commercial borrowing can be taken by the eligible borrower, or if the 300% of the net worth is higher, this much of the borrowing can be taken by the eligible borrower. This is the most important point in the whole direction. That's why I have not taken a session on the complete direction, because in this particular direction there were various extra points that you do not have to focus on. Just the few points that you have to focus on I have brought here. Okay, so USD 1 billion is the answer here. So basically, Foreign Exchange Management, Borrowing and Lending First Amendment Regulations 2026 has been recently released by the Reserve Bank of India. So any person resident in India other than the individuals, so any person means any entity that is resident in India, that is incorporated, established or registered under a central or state act, is eligible borrower. Okay, eligible borrower is also the borrower that is under the restructuring scheme or corporate insolvency resolution process. They can also take the borrowing, they can also take the external commercial borrowing if they have been permitted under the restructuring or resolution plan. Eligible borrower is any borrower which is also under the investigation or adjudication. If they are allowed, they can take the external commercial borrowing. The borrowing limit is that an eligible borrower may raise external commercial borrowing up to the higher of outstanding external commercial borrowing up to $1 billion or the total of 300% of the net worth. Okay, so the higher of $1 billion or 300% of the net worth, whichever is higher, that can be borrowed by the eligible borrower. Recognized lenders are person resident outside India, that is any entity that is outside India, branch outside India of an entity whose lending business is regulated by Reserve Bank, a financial institution or a branch of financial institution that is set up in International Financial Service Center. Eligible borrower, they can raise the external commercial borrowing with minimum average maturity period of 3 years. That means external commercial borrowing should have a maturity period of at least 3 years. Eligible borrower that is engaged in manufacturing sector. So if an eligible borrower, it is engaged in manufacturing sector, they may also raise external commercial borrowing with average maturity period between 1 year to 3 years. That means they can not only raise more than 3 years, like they can not only raise the ECB for more than 3 years, but they can also get the external commercial borrowing for the period of 1 year to 3 years, subject to the condition that outstanding amount of such ECBs, okay, subject to the condition that outstanding amount of such ECBs shall not exceed $150 million. So that is the idea, that maturity period should be more than 3 years. Maturity period should be more than 3 years for the external commercial borrowing. But in the case of the eligible borrower, if it is engaged in the manufacturing sector, then it can raise the external commercial borrowing for a period of 1 year to 3 years. And such ECBs shall not exceed more than $150 million. Okay, so this is the idea. These are the most important points from this particular article that you have to focus on. Now coming to the next question, that is Reserve Bank of India has now decided to mandate unique transaction identifier for all specific derivative transactions carried out at the over-the-counter market level. Which of the following statements is or are incorrect regarding UTI that you have to tell? So basically UTI, that is the unique transaction identifier, has been mandated for the over-the-counter transactions. Okay, so now which of the following statements is or are incorrect regarding the unique transaction identifier? UTI shall be generated in accordance with the UTI technical guidance issued by the CPMI of the Bank of International Settlement and the IOSCO. This is absolutely correct. It shall have a maximum of how many characters? So it is not 32 characters. So how many characters for the UTI should be there? So the UTI shall have a maximum of how many characters, comprising of the legal entity identifier, which itself has 20 characters, generating entity followed by a unique identifier. If a transaction is reported to the Clearing Corporation of India Limited Trade Repository without the UTI, the CCIL Trade Repository shall generate the UTI for the transaction. That means there is a waterfall level that different entities, they have the responsibility to generate the UTI. If they do not generate the UTI, then the CCIL Trade Repository has the responsibility to generate the UTI. A life cycle event where novation is happening, that means a party is leaving the contract, another party is getting into the contract. In this kind of case, that is the life cycle event. There is a new UTI that is generated. Okay, the direction shall come into effect from January 1, 2027. Absolutely correct. Okay, so B is the incorrect statement because the UTI shall have the maximum of 52 characters. Okay, so very good Kashish, very good Akshu. 52 characters are there, should be there. Okay, so B is the incorrect statement. UTI, it shall be generated in accordance to the technical guidance issued by the CPMI of Bank of International Settlement and IOSCO. It shall have, the UTI shall have a maximum of 52 characters, and the UTI will be applied to OTC derivative transactions entered into or after January 1, 2027. Okay, so this is the idea. Now this is the waterfall level that the CCP, that is central counterparty, has to generate the UTI. If it does not generate the UTI, the next entity is responsible to generate the UTI. At last, if no entity is generating the UTI, the CCIL Trade Repository has to generate the UTI. Okay, now coming to the next question, the RBI has released Credit Facilities Amendment Directions 2026 for small finance banks and commercial banks to introduce a new framework for loan against eligible securities and lending to capital market intermediaries. Now, which of the following statements is or are incorrect in regards to the direction? Okay, so RBI has released the Credit Facilities Amendment Direction 2026 for the small finance bank and the commercial bank. Now, a new framework has been provided for loan against eligible securities. Which of the following statement is or are incorrect in regards to the directions? So loans can be provided against listed debt securities, including convertible debt securities rated BBB or higher. That is absolutely correct. The amount of loan that can be granted to individuals against eligible securities other than those mentioned above shall be capped at 1 crore rupees per individual. This is also correct. Okay, banks may grant loans to individuals after ensuring due diligence for subscribing to shares. So banks can give loans to individuals for subscribing to shares under IPO, FPO, or under employee stock option up to 25 lakh per individual. So it is not 75 lakh, it is 25 lakh per individual. Banks can give loans for subscribing to shares for buying the shares to the individuals, but it is limited to 25 lakh per individual. So third one is wrong, and that's why the right answer is that, which is the incorrect statement. So 3 only, D is the answer here. Okay, so basically loans against eligible securities, the commercial banks, the small finance banks can give loan against the eligible securities. These are the eligible securities. Okay, now there is also the loan to value ratio, that how much maximum loan can be provided against the collateral value, against the share value, or against the debt instrument value. So this is the loan to value ceiling, that is the maximum loan that can be given against the collateral value. Then we have also discussed that the banks may fix their own prudential limits in terms of their approved policy for loans to individuals against the debt securities and such, but for other kind of loans, the amount of loan that can be granted to individuals against eligible securities other than mentioned above, so they shall be capped at 1 crore per individual. That is correct. Okay, now banks may grant loans to individuals after ensuring due diligence for subscribing to shares up to 25 lakh per individual. So this is the idea. Now 75% of the subscription. So if you want to buy 50 lakh worth of, or you want to buy 20 lakh worth of the shares in the IPO, 75% can be provided by the bank, 25% should come from your own pockets. That is the idea. Okay, so a minimum cash margin of 25%, that means minimum 25% should come from the individual only, so that the individual has its own risk in buying the shares, not only the borrowed money. So banks can grant loans to individuals for buying the shares. Up to 25 lakh per individual can be given as the loan, but only 75% of the subscription value can be provided by the bank. 25% of the money should come from the individual purchasing the shares. Coming to the next question, under the Credit Facilities Amendment Direction, for small finance bank and commercial banks, they are not permitted to provide loans against their own security. So the small finance bank and commercial bank, they cannot provide the loan against their own securities, provided that a bank can provide the loan to individuals against the long-term bonds issued by it for infrastructure financing, and such loans shall be subject to a ceiling of what? Per borrower. And a bank can lend against the certificate of deposits and buy back their own certificate of deposits, where such certificate of deposits are held by mutual funds. So basically, the small finance banks, the commercial banks, they cannot provide loans against their own securities, but these are certain exceptions. So the bank can provide loan to individuals against its infrastructure financing bonds, and this is up to limit of 10 lakh per borrower. Okay, so B is the answer here. 10 lakh per borrower is the limit. So following loans by a bank shall not be permitted. So bank cannot provide loan against its own securities, but the bank can extend loan to individuals against the long-term bonds issued by it for infrastructure financing, subject to a ceiling of 10 lakh per borrower. As well as a bank may lend against the certificate of deposit held by mutual funds or buy back the certificate of deposit held by the mutual fund. Coming to the next question, try to answer this question. So a custodian bank may issue irrevocable payment commitments on behalf of their clients in favor of a clearing corporation of a stock exchange. Okay, so the custodian bank that keeps the custody on behalf of its client, that keeps the custody of the shares of the different financial instruments. So custodian bank can issue irrevocable payment commitment on behalf of their client in favor of a clearing corporation of a stock exchange. Issue of an IPC, issue of an irrevocable payment commitment by a bank on behalf of its client is treated as a financial guarantee from the custodian bank with a credit conversion factor of what percentage? Buffer capital is not required to be maintained on the full irrevocable payment commitment amount. Capital is required only on the portion of the capital market exposure. So the amount classified as capital market exposure will have the risk weight of how much? So basically there is the credit conversion factor of 100%, and the capital market exposure should have a risk weight of 125%. This we have discussed in a session in February itself. So the right answer here is that 100% is the credit conversion factor and risk weight is 125%. Okay, so C is the right answer here. C is the right answer. Okay. So this is the idea that custodian bank can provide irrevocable payment commitment, but this irrevocable payment commitment will have the credit conversion factor of 100%, while the capital market exposure of the bank will have 125% of the risk weight. Okay. Now how much the exposure the bank can have? So exposure depends on the fluctuation in the value. Okay. So if the IPC has been provided, the trade is conducted today, the trade is initiated today, tomorrow it will settle. So for the one day when tomorrow it will settle, so for that one extra day, 30% of the net settlement obligation that has to be kept as the capital market exposure, and 125% of that amount. Okay, plus for the T+2, that means if the settlement will happen, like today you have initiated the trade, the settlement will happen like day after tomorrow. So in that case, 50% of the net settlement obligation, 50% of the settlement obligation that the shares are being settled at, or whatever instruments are being settled at, let's say 100 crores. So 50% of that multiplied by the risk weighted asset. Okay, so this is the idea. Now, if you want to know more in detail, you want to understand this, then do see the session under the Finance 360 degree series. So in the Finance 360 degree series, I have taken a detailed session where I have already explained about the IPCs. This has been explained in the same session where I have taken the discussion on the Credit Facilities Amendment Direction 2026. So in the Credit Facilities Amendment Direction this IPC topic has also been discussed. Okay, now coming to the next question, that acquisition finance may be extended by a commercial bank. So only a commercial bank can provide the acquisition finance to an Indian non-financial company for acquiring equity share stakes in domestic or foreign companies as strategic investment. So basically, acquisition finance under which a company can take the loan to acquire another company. Okay, so this is acquisition finance. So acquisition finance can be extended by a commercial bank to an Indian non-financial company for acquiring equity stakes, for acquiring the stakes in domestic or foreign companies as strategic long-term investment. The acquiring company, whether listed or unlisted, must have a minimum net worth of how much, and must have the net profit after taxes reported in each of the previous dash consecutive financial years. So what is the answer here? So basically, the acquiring company must have a minimum net worth of 500 crores, and in the previous 3 consecutive financial years, there should be net profit after taxes. Okay, so that is the idea, and C is the answer. So acquisition finance, the acquiring company must have the minimum net worth of 500 crores and the net profit after taxes for 3 consecutive financial years. Additional criteria for unlisted entity is that the investment grade rating should be BBB or above. Okay. Now coming to the next question. So as per the Reserve Bank of India, Commercial Banks Concentration Risk Management Amendment Directions 2026, the aggregate CME of a bank on both solo and consolidated basis shall not exceed dash of its eligible capital base. So try to answer this question. So as per the Reserve Bank of India Commercial Banks Concentration Risk Management Amendment Direction 2026, the aggregate capital market exposure of a bank on both solo and consolidated basis shall not exceed what percentage of its eligible capital base. So basically try to understand that the commercial banks, they have the limit on how much exposure they can have in the capital market, how much exposure, how much investment they can do in the capital market, in the stocks, in the shares, in the financial instruments, as well as how much of the loans they can give against the shares, against the debt instruments and such. So the commercial banks, for them, there is the limit on the capital market exposure. Okay, that how much exposure a bank can have in the capital market. There can be direct exposure, that is directly the bank is doing the investment in the capital market, or there can be indirect exposure that the bank is giving loan to the individuals to invest in the shares, so that is indirect exposure. So there are limits. Okay, so the aggregate capital market exposure of a bank on solo basis as well as on the consolidated basis, that means the bank and their subsidiaries, they shall not exceed 40%. They shall not exceed, very good, 40% of its eligible capital base. So this is the idea. Again, here just 4 points are important, that the total capital market exposure of a bank on both solo basis and consolidated basis, that is including its subsidiaries, shall not exceed 40% of its eligible capital base. A bank direct capital market exposure, that is directly the bank is investing in the shares, in the bonds, in the debentures and such. So bank's direct capital market exposure shall not exceed 20% of its eligible capital base on both solo and consolidated basis. The bank aggregate exposure to acquisition finance. Acquisition finance means that the bank is giving loan to a company to acquire another company, to acquire the shares of the other company. Okay, so a bank's aggregate exposure to acquisition finance shall not exceed 20% of its eligible capital base within the total limit of 40% of the eligible capital base. Within its aggregate capital market exposure limit, a bank shall have a separate sublimit for intraday exposures to a single counterparty and such. So these are the capital market exposure norms for the commercial bank. Now leave the third one, and the other norms are also applicable to the small finance bank. Okay, so that is the idea. Now coming to the next question. The report of the 16th Finance Commission was tabled in Parliament on February 1, 2026 for the 5-year period between 2026-27 and 2030-2031. The share of states in the divisible pool of central taxes has been recommended at what? So remember that there is the vertical devolution of taxes. So central government is raising the taxes, collecting the income tax, corporate profit tax and such. So whatever taxes are being collected by the central government, okay, the taxes that are collected by the central government, from that deduct the surcharge, deduct the cess, and this is the net proceeds of taxes that the central government has to give a share to the state governments also. Okay, so the 16th Finance Commission or the Finance Commission is the one that decides the percentage that how much of the vertical devolution should happen from the net proceeds of taxes, how much the central government should distribute to the state governments. Okay, so the 16th Finance Commission has decided that for this time period, the share of states in the divisible pool of central taxes in the net proceeds of taxes has been recommended at 41%. This is the absolutely correct answer. Okay, so central government from its taxes minus the surcharge minus the 6 so from the net proceeds of taxes, that is from the divisible pool of central taxes, the central government has to provide the share to the state government. Okay, that is decided at 41%. So the share of states in the divisible pool of central taxes has been recommended at 41%. So this is the idea. So under the vertical devolution, 41% the central government has to distribute to state government from the net proceeds of taxes. Okay, now the 16th Finance Commission was chaired by Dr. Arvind Panagria also. That also you have to remember. Coming to the next question, the 16th Finance Commission has defined income distance as the difference between the per capita gross state domestic product of a state from the average of the per capita gross state domestic product of the top 3 large states. So basically the difference has to be seen that the highest the states with the largest gross state domestic product per capita gross state domestic product. So the states with the largest per capita gross state domestic product, their average has to be taken of the 3 large states, and from there it has to be seen that how lower your per capita gross state domestic product is. So the larger the income difference is, the larger the share or the larger the larger the benefit will be provided to you basically. So here the 16th Finance Commission has defined the income distance as the difference between the per capita GSDP of a state from the average per capita GSDP of the top 3 large states with the highest per capita GSDP. Now per capita GSDP, what is the weight given to the income distance under the 16th Finance Commission, and the state that have the highest income difference or the states that have larger income distance, they will get more horizontal devolution. Okay, so the states that have larger income difference, they will get larger portion from the net proceeds of taxes. Okay, so here 42.5% as per the 16th Finance Commission, the income distance is given the weightage of 42.5%. So right answer here is D. Remember this, that in the 15th Finance Commission, the income distance had the weightage of 45%, but under the 16th Finance Commission, the income distance has the weight of 42.5%. This is something that has been changed, and that's why it is important. That's why you have to keep in mind. Okay. Again, if you are not able to understand that what is the income distance, what is this per capita GSDP and such, I have taken a detailed session on the 16th Finance Commission. You can understand that this Finance Commission is providing the recommendations for the 5-year time period. So this is a very important recommendations, or this is a very important report that you have to go through. So do go through the 16th Finance Commission session that I have taken so that you understand the nitty-gritties. Okay. Now, there is also the change in the population criteria and the demographic performance weightage. Why the weightage has changed, and all these points have been discussed in the session for the 16th Finance Commission. Now, coming to the next question, that is which of the following countries has signed an amending protocol with India to update Double Taxation Avoidance Convention, aiming to align the tax treaty with international standards and strengthen the economic cooperation. So basically, which of the following countries has signed an amending protocol with India to update the Double Taxation Avoidance Convention? So basically, Double Taxation Avoidance Agreement or the Double Taxation Avoidance Convention, it is the agreement that is signed between two countries so that the same income is not taxed twice. Let's say there is a French citizen or there is a French resident who is investing in the Indian shares. Now there is the dividend that is being earned by this French resident. Now it is being taxed in India also, because the dividend is earned from India, from the Indian company, from the Indian shares. The same dividend is being taxed in France also, because the person is a French resident. So this leads to double taxation. The same income is being taxed in India, is being taxed in France. The same income is being taxed in two countries. That's why this becomes problematic for the people, for the investors, for the people that are earning the income. Okay, that's why the countries, they sign the Double Taxation Avoidance Agreement so that the same income is not taxed twice. Now in France, has signed the amending protocol with India to update the double taxation avoidance agreement? So here the right answer is France. Okay, it provides now the new convention or the updated convention. Basically, it provides full taxing rights in respect of capital gains arising from sale of shares. So basically, if a French resident is selling the shares of an Indian company, then India has the right to tax this income. Okay, so this is the idea. So it provides full taxing rights in respect of capital gains arising from sale of shares of a company to the jurisdiction where such company is resident. The amending protocol also modifies the taxation of income from dividend by replacing a single rate of 10% tax with a split rate of 5% for holding at least 10% of the capital and 15% of tax for all other cases. Okay. Now coming to the next question, SEBI issued final guidelines on mutual fund scheme categorization, introducing the life cycle funds. Which of the following statements is or are correct regarding the life cycle funds that you have to inform? So these are the new kind of funds that have been introduced. That's why they are very, very important. Okay. So these funds can be launched only for a fixed maturity of 10 years. No, these funds can be launched for a period of 5 years to 30 years. Okay. So these funds can have the maturity of 5 to 30 years. Okay. Life cycle funds can invest across multiple asset classes including equity, debt, gold and silver. Absolutely correct. These funds impose graded exit load. That means the exit fee is graded. It depends on the years that you have been in the fund. So if you are exiting first year only, then you have to pay the exit fee of 3%. If you are exiting on the second year, you have to pay the exit fee of 2%. If you are exiting on the third year, you have to pay the exit fee of first year of 1%. So to encourage long-term investment. So if you are exiting on the year 1, exit fee is 3%. If you are exiting year 2, so the exit fee is 2%. If you are exiting in the year 3, you have the exit fee of 1%. Okay, so this is also correct. So second and third statements are correct. That's why B is the right answer. So here you can see that the life cycle funds have been introduced, and open-ended target dated funds you can enter whenever you want. The maturity options are 5 years to 30 years. Okay, predefined asset allocation glide path, and up to 6 schemes are there. Asset allocation, you can the fund can allocate the funds in the different kind of asset. Exit load, that is exit fee structure has been given. The longer that you keep the funds, the lesser the exit fee you will have to pay. Okay, so that is the idea. Now, foreign direct investment equity inflow into India's banking sector has sharply declined from USD 898 million to only 115 million in financial year 2024-25. With reference to foreign shareholding in public sector banks in India, which of the following banks has the highest foreign shareholding? So these are the kind of questions that if you read the question, then you can answer the question just from the logic perspective. So try to answer this question, that which of the following public sector bank has the highest foreign shareholding? So it is the State Bank of India. Okay. Now, so this is the idea that foreign direct investment equity inflow into the India's banking sector has sharply declined, but the State Bank of India is the one that holds the highest foreign shareholding, okay, or that gets the highest investment. Now, India will begin sharing cross-border cryptocurrency transaction data under a global information sharing framework proposed in the Union Budget 2026. This framework, known as the Crypto Asset Reporting Framework, is led by which of the following organizations? Is it led by International Monetary Fund, World Bank, Financial Action Task Force, Organization for Economic Cooperation and Development, International Organization for Securities, Commissions? So basically, India has agreed to share the cross-border cryptocurrency transaction data under the Global Information Sharing Framework. This has been proposed in the Union Budget 2026. This framework, known as the Crypto Asset Reporting Framework, is led by which of the following organizations? So this has been led by OECD. So this is the answer. Okay. So basically, India will begin sharing cross-border cryptocurrency transaction data. Crypto transactions are reported under the Crypto Asset Reporting Framework, which is a global standard led by OECD. So this is important. Just you have to remember that where the data is shared, under which framework the data is shared, and this is led by which organization. So OECD is the answer here. Okay. Now, coming to the next question, with reference to penalties proposed under the Union Budget 2026 for crypto reporting non-compliance, consider the following. So basically, there are penalties for non-compliance of the crypto reporting norms. So if you have to follow the crypto reporting norms, and if you are not following the norms, then there are certain penalties. You have to tell that which of the above statements is or are correct. A penalty of rupees 200 per day is imposed for failure to submit required statements. Absolutely correct. A flat penalty of 50,000 rupees is imposed for incorrect reporting. This is also correct. These penalties will be effective from 1st April 2026, not 27. Okay. So first and second statements are correct, and that's why the answer here is A. Okay. So India will begin sharing cross-border cryptocurrency transaction data under a global information sharing framework led by OECD. Okay, now here it has been informed that there are Union Budget 2026 proposes penalties to enforce compliance, a 200 per day fine for failure to submit required statements, and a 50,000 flat penalty for incorrect reporting. This is effective from April 1, 2026. So from April 1, 2026, the domestic reporting and compliance has to be followed. But from April 1, 2027, India will begin sharing and receiving cross-border crypto transaction data. So for domestic reporting, that has to initiate, or the reporting with the compliance has to initiate from April 1, 2026. If you do not comply with the norms, then you have to pay the penalties. But for the international transaction data, the timeline has been decided from April 1, 2027. Okay. Chalo. Coming to the next question, that Insurance Regulatory and Development Authority of India has reconstituted the Reinsurance Advisory Committee for a term of 3 years. Who has been appointed as the chairperson of the Reinsurance Advisory Committee? So here, just like if there are committees that are being formulated and the committees are for a long period of time, then you have to remember the chairperson. That is the only thing that you have to keep in mind. So here the chairperson of the Reinsurance Advisory Committee is Mr. A.V. Girija Kumar. Okay. So this is the answer. So the primary goal of this committee is to suggest mechanisms to maximize the retention of insurance premiums within the country rather than ceding them to foreign reinsurers. Now coming to the next question, that JustPay, a Bangalore-based payment infrastructure company, has officially become the first unicorn of 2026. What is the minimum valuation required for a startup to be classified as a unicorn? These are Feb current affairs. Remember, see, whenever I take the monthly revision sessions, I will take the extra topics also that is not required from the that is not required to be dealt in the complete detailed session. So they are directly taken under the monthly revision session. So if you are going through the magazines, if you are going through the magazines of the EduTap course, okay, then these are the articles that are given under the finance current affairs. So right now there are like 27 articles that have been given under the Feb file of finance current affairs. You do not have to cram all the facts, you do not have to go through all the articles. So I have brought the questions from the most important articles. Okay, that is the idea. As well as in the finance 360-degree session, I take the most important RBI notifications, the RBI press releases, the finance current affairs, but there are certain one-liner finance current affairs that we directly discuss in the monthly revision session, or there are certain finance current affairs that were not covered in the finance 360-degree session, so they are covered under the monthly revision session. So you are getting the holistic coverage, so that anything that is left behind that is not covered in the finance 360-degree session because it was not required in detail, so that is getting covered in the monthly revision session. Now, try to answer this question. So here the answer is D, that is over $1 billion. So JustPay, a Bangalore-based payment infrastructure company, has officially become the first unicorn of 2026. What is the minimum valuation that is required for a startup to be classified as a unicorn? So that is $1 billion is the minimum valuation. So the company, the unicorn, is a startup company valued at over $1 billion, and JustPay has become the first unicorn of 2026 for India. Okay, this is a Bangalore-based payment infrastructure company. Now coming to the next question, that budget 2026-27 proposed an increase in the securities transaction tax to discourage aggressive retail speculation in futures and options trading. So the securities transaction tax on options premium and exercise of options to be raised to what percentage from the previous rate of 0.1% and 0.125%. So basically for the securities transaction tax on the options premium and the exercise of the options, the percentage has been raised from the previous rate. Previous rate was 0.1% for the option premium, and for the exercise of options the rate was 0.125%. so the rates have been increased. The securities transaction tax rates have been increased to what? For the option premium, for the option exercise, so the rate has been increased to 0.15%. That is the correct answer. Well done. So basically the securities transaction tax has been increased on futures from 0.02% to 0.05%. Okay. Securities transaction tax on the options premium has been increased from 0.1% to 0.15%. The securities transaction tax on the exercise of options have been increased from 0.125% to 0.15%. This is the idea. I hope this is very much clear that the securities transaction tax has been increased for both future and options. For future it has been increased from 0.02% to 0.05%. For option it has been increased from 0.1 and 0.125% to 0.15%. Now, which company has collaborated with the NPCI to build a payments native sovereign AI layer for India's digital payment infrastructure? So NPCI has collaborated with which company to build a payments native sovereign AI layer? So the answer here is NVIDIA. Very good. The answer here is NVIDIA. Okay. So basically the NPCI announced a collaboration with NVIDIA to build a payments native sovereign AI layer for India's digital payment infrastructure. NPCI plans to use NVIDIA's Nemotron, a family of open models, and Nemo framework in developing the foundational AI layer, which is built upon NPCI's AI model, that is financial model for India. So basically we are trying to make the sovereign, the independent or the domestic AI layer for India's digital payment infrastructure. So this is the idea. Now coming to the next question, that is to support the aspirations of India's small businesses, artisans and startups to access global markets through e-commerce, Union Budget 2026-27 announced the complete removal of the current value cap of rupees how much per consignment or courier exports. So what was the cap that has been removed now? So basically to support the aspirations of India's small businesses, Union Budget has announced complete removal of the current value cap of rupees 10 lakh per consignment on courier exports. So this limit on the courier exports have been removed now. So this is a big step that has been taken, and that's why you have to keep it in mind. So in the PIB also this was discussed that the budget proposes complete removal of the current value cap, current limit of 10 lakh per consignment on courier exports. So the current value limit of 10 lakh per consignment on courier exports has been removed. Okay. Now coming to the homework question. So this is your homework question that you have to answer in the comment section below. The 16th Finance Commission has recommended that the center should bring down the fiscal deficit to 3.5% of the GDP by 2030-2031. So fiscal deficit is the deficit of the government where the government is spending more than the receipts of the government. So fiscal deficit is equal to total expenditure minus total receipts excluding borrowing. So fiscal deficit actually shows the borrowing requirement of the government. So the higher the fiscal deficit, the higher the borrowing requirement of the government. Okay. So it has been said by the 16th Finance Commission, it has recommended that the central government should reduce the fiscal deficit, its borrowing requirement to 3.5% of GDP by 2030-31. It recommended that states' fiscal deficit continue to be capped at what percentage of their respective gross state domestic product. So what is the percentage that you have to inform? Coming to the next question. So these are the two homework questions, question number 24 and question number 25. With reference to a recent RBI initiative aimed at strengthening primary urban cooperative banks, consider the following features. Focus on capacity building, skill enhancement, operational resilience, coverage of approximately 1.40 lakh participants across functions, combination of physical training programs, implementation in partnership with the umbrella organization of the urban cooperative banks, training delivery in regional languages, location close to UCBs. So which of the following initiatives best describe the above? So try to answer this question. These are the two questions that you have to answer in the comment section below. Question number 24, question number 25. Let's see how many of you are able to answer these two questions correctly. And yes, you will get the PDF of the session. The PDF of the session you will get in the Telegram channel, for which the link has been provided in the description box below. So you will get the PDF of the session by tomorrow 12 p.m. Okay, by tomorrow afternoon, you will get the PDF of the session. The link for the PDF of the PDF will be provided in the Telegram channel of EduTap, and the link for the Telegram channel of EduTap is provided in the description box below. So this is it for today. I hope you enjoyed the session. I tried to wrap up the session in a faster manner because the Feb detailed session has already been taken. So this was just a revision session, as well as the March onwards, the topics will become more important. So February, you just have to do the overview. You just have to do the brief coverage in the February month for the current affairs, for the RBI notifications, for the finance current affairs. From March onwards, you have to be more serious in your coverage. Okay. So in February, just do an overview of the RBI notifications. Just do an overview of the finance current affairs. That's it. So this is it. Thank you, everyone. Thank you for joining.